This has been one of those markets investors want to forget. Is the bottom in, or is there more volatility ahead?
Well, first of all, good morning, Dom. Thanks for having me on the show. So, look, I want to say that the bottom's in. I think that there's several preconditions that have to be met for that. First is going to be that we need to see some sense that the case curve is beginning to bend here. And again, there's lots of different statistics that are being quoted. You heard the president and some administrative officials talking about different models. There's a couple of things we're looking at to determine exactly where the caseload is slowing down. One is simply going to be in terms of the number of the hospital bed utilization. That's probably one of the cleanest ways to read it, because we know that some of the data around the caseload is underreported because the testing is not so widespread. So I do think one of the things we're going to look at is going to be, again, the hospital utilization rate. The second is going to be the number of states that are in lockdown, because the more that you have these social distancing and mobility restrictions, the more likely it is that you get the under control. And then lastly, it's a grim statistic, but it's one we have to focus on. It's also the mortality rate. So first, we need to see that this bending of the curve. Secondly, we need to see, Dom, is that the policy response is both adequate in terms of size and also effective in terms of targeting. Now, I would argue that on the policy side, we have seen what we consider to be a surprisingly quick initiative, first by the Fed and second by fiscal policy. The Fed has basically broken out the entire crisis playbook. And then recently we've also seen as elected officials understand, and we've seen a massive mobilization, therefore, both on the monetary and fiscal policy side. I think the issue which you raised earlier in the show is it enough, or will more be required?
All right, so let's talk about the word unprecedented, because I've heard that word used a lot with regard to not just the market perspective on what's happening with COVID-19, but the economic perspective as well, that we haven't been able to see anything like this in terms of its effect on the U.S. economy and perhaps globally as well. What exactly are you looking towards in terms of precedent about how we emerge from this as a market and economy?
Well, I think you mentioned unprecedented, which I think that's an important term here, because we don't have any framework for comparing this to. We can look at different historical periods, and we've had sharp short-term deteriorations in economic activity, but there's not exactly something we can model for here. Because remember, what we're doing is this is not just an exogenous shock that then we work our way through. This is an intentional slowing of economic activity that's meant to contain the virus. So there's really nothing on the record that we can look at here, because historically, when you get an exogenous shock, you immediately try and push back against it. Here, you actually have to let it run its course a bit, because you want to first control the public health threat, which is disease, and then restore economic growth. So our view is that the second quarter is going to be, one of the worst, if not the worst, on record. But then it's going to be important to see whether we set up the infrastructure from a recovery standpoint in terms of monetary and fiscal policy that allow, once we start to work through the caseload, once the virus begins to crest, beginning the process of getting the economy back on track. So we expect to see that begin to happen in the third quarter and then more forcefully in the fourth quarter.